And so our point was that we would be in the market to build our reserves above normal levels. And we had indicated that we would be buying up to 100 million US dollars a month. And obviously still cognizant of the stability in the market, so we wouldn't be destabilizing the market. And I think that was what we indicated to the markets, but some dealers misunderstood this. But that is the fears, I guess, that they had. A third element on this, which has, in terms of the financial foreign exchange market, relates to some indiscipline by some malicious traders or malicious actors in the market. Unfortunately, we are not saved of that scourge. We've seen it in other markets as well. So I think the point again here is we appealing, aside from the rules, we also appeal to let's say the good ethics, the good sense of ethics of all our players around the markets, particularly at this time when we at a time of crisis. So those are the points I wanted to make in terms of the foreign exchange market, which we therefore continue to see that it will be stable, and we will continue to act as we have always acted. Our exchange rate policy has not deviated. It's always been a flexible exchange rate regime, but we intervene to minimize volatility. I think two other points before I finish, or two other areas. I want to say a few things about the banking sector. Now, quickly, the private sector credit growth, private sector credit has grown, or the growth of that has risen to 7.7% in February from 7.1% in December. So again, we are seeing this sort of gradual increase in the pace of private sector credit growth. But looking forward, the impact of the coronavirus, or the pain point, the first one of this would be on personal loans. And I think the objective now for us as policymakers and MPC is to ensure that the asset quality, which will be the first challenge, is we stop it from becoming a liquidity problem. Banks are liquid. There's ample liquidity, overall liquidity, but you could end up getting pockets of tightness or specific institutions or specific areas. And so that's why we need to be sure, we need to ensure that it doesn't become a liquidity problem, either generally, but more specifically in specific points. So going back then to personal loans, which, as you know, account for something like 28% of our value of loans. And the issue there would be if people, let's say, let go, so job losses lead to obviously problems in their repayments, and also it leads to significant anxiety and stress. So the idea is to ensure that it doesn't get to that point. So the MPC's decision, or the decision that the MPC took, have to be seen against the backdrop of decisions taken last week. So we do know, you do know that, or you know that there were decisions that were taken, and the decisions relate to banks providing relief to borrowers on their personal loans based on the individual circumstances arising from the pandemic. And to provide relief on personal loans, banks will review requests from borrowers for extension of their loans for a period of up to 1 year. And borrowers were advised to contact their own respective banks to initiate this process. Now, there was also something else, which is medium-sized enterprises. This is the SMEs and corporate borrowers were also advised to contact their banks for assessment and restructuring of their own loans based on their respective circumstances arising from the pandemic. So there are a few other measures, but I think I wanted to mention those specific measures. And consequently, the MPC, looking at this, it decided to lower the CBR rate, that is our indicator, to signal lower rates, but particularly on deposit rates, And this will allow to create more room for the banks. But it is also important to appreciate that everybody needs to has to take a share. I mean, everybody needs to take a bit of the burden of the crisis. And in this case, depositors will need to accept lower rates, lower deposit rates. Secondly, the MPC lowered the cash reserve ratio by 1 percentage point to release liquidity that will help bridge the gaps that would be created by the restructuring. And this was something in the order of 35 billion shillings. And that would be availed to the banks when they demonstrate what they are doing in terms of restructuring and supporting the borrowers that have been hit by the pandemic. So in that sense, it's not generalized. So we are trying to be as directed as possible, meaning the policy itself is directed to the point of greatest need, not sort of a generalized support on every single point. Another point is that we will work to strengthen liquidity management, we as the central bank. And in this, there are 2 points. The first is the interbank market. We need to look at it again and make sure that this is functioning smoothly, and ensure that it works even better than before. And secondly, from today, we will extend the tenure of our repos from 28 days all the way to 90 days. And that will allow banks, in case of liquidity need, they can bring in through this repurchase agreement, the repo, they can bring in their T-bills, and we can have a repo agreement for as much as 90 days. Now, obviously, our expectation is that within 90 days, the uncertainties around the coronavirus pandemic begin to clear, and then things will probably begin moving towards where they should be, to the normal points. One last section then before I finish, and this relates to the I should also have said that in addition, we've also seen that banks have been banks, of course, support the measures that we announced last week, but they've gone further, and their banks are moving on their own to provide even more relief to some of the noted sectors, for instance, the SMEs, and indeed also personal loans. So those are things that I think you'll see more and more as in the next few days and next few weeks. So the last point relates to the things on the fiscal measures and things relating to the government. And the first of this is the pending bills, which we have seen. The payment of pending bills have gone relatively well over the last couple of months. And there's very little pending bills from government, that's the national government. And in the counties, we have seen, of the 47 counties, we've seen 16 have fully paid their pending bills, and 31 still have some some pending bills to resolve. So we have actually seen the benefit of this from the perspective of some of the businesses that were owed this money. So that is a significant support, as it were, for our businesses. And then secondly, we expect a fiscal package very soon, targeted and with involvement of the private sector and labor. It is important that that all three parties work together to put forward a strong and targeted fiscal package that will help push us or limit the damage and the cost of the coronavirus. So now I finish. From the perspective of the central bank, we stand ready to ensure the smooth operation of our financial markets and the stability of the banking sector. I'm also reminded that the crisis started in Wuhan in China, and it's interesting to note that today they announced that they will end the lockdown in Wuhan in April 8th. So they are already signaling that the lockdown will be ended. So that's the rainbow. And indeed, in the province of Hubei, the lockdown ends tonight. This is significant, and we are very happy that they've made those steps after what obviously has been a rather tough several weeks. Now, at the same time, it's interesting that the word crisis in Chinese has two characters, and the characters relate to danger and opportunity. So yes, we do see danger in this crisis, but we also see opportunities. We are reminded of our connectedness, our humanity, and we will beat this together as a country. Thank you very much.
Thank you very much. That was Governor Dr. Patrick Njoroge, Governor of the Central Bank of Kenya. And you may have realized that this press briefing is being carried out purely on the web. You're receiving this through various channels, the Central Bank website, YouTube, Facebook, Twitter, and the different television stations that have picked up this feed that we have. And what we've asked you members of the media to do is send through your questions on the different channels. We have the channels that are open to you. And so, Governor, I want to start giving those questions to you. And I'll start with a question from Fred Aminga of the People Daily. His first question is, looking at other nations already hit by COVID-19 and their economic safeguards, what would it take to bring the benchmark rate to zero? Looking at other nations already hit by COVID-19 and the economic safeguards, what would it take to bring the benchmark rate to zero? That is Fred Aminga from the People Daily.
Thank you, Fred. I don't know what the value would be for bringing the benchmark rate to zero. But I think the point I would make is that maybe you are comparing us with the US and other advanced economies. The question I would have is first look at where the interest rate, the real interest rate would be, right? So as long as we have interest rates, inflation rates around 5%, if you brought it down to about 7%, that gives you something in the order of 2% real rate. My point is, I don't think that's what we want to do. We have also seen the problems that it has created in the advanced economies, particularly if it lasts for too long. What we are doing, on the other hand, is to move in a measured way, meaning we are taking deliberate measures, but calculated. So these are all calculated risks. We are not going with all our ammunition. Sure, we do have big bazookas, but we don't want to begin by using all our firepower on day one, particularly when we don't know how deep this crisis will be. So I think, Fred, I would emphasize that we are moving ahead in a measured way. This is a measured response. And the next one on deck is, of course, the fiscal side. So let's see. And I think a lot of the support should be coming from the fiscal measures, which, as I announced, will be revealed shortly.
Next question is from Alex Mwangi, business reporter at NTV. The question is, what do you think are the long-term adjustments that financial policy makers need to make to provide sufficient buffers against pandemics in the future? What do you think are the long-term adjustments that financial policy makers need to make to provide sufficient buffers against pandemics in the future? That's Alex Mwangi, NTV.
I don't know, Alex. I think we could talk about our side, but Alex, your question reminds me of a question that was leveled to a coach of, let's say, a particular football team. I'm not going to mention the football team because I don't know which football team you support. But the point here is the following. I think there are two levels, a bit like we mentioned. The policy response, first and foremost, should be related to the health crisis. And that, I think, is something we need to do better. I don't know how we can do, what measures could be put in terms of limiting the potential transmission in the, very, let's say we do a lot of travel, right? All of us do a lot of travel, and this is how this pandemic is spreading. So one could think about those things, but clearly that's not an area that we have any comparative advantage or any sound ideas about. But I think what we as policymakers on our side, particularly in the central bank, need to do is to understand that shocks will come from other areas. And there was a time when we were all excited about let's say, the benefits of globalization, particularly when we realized the savings that various supply chains, and for that matter, even just-in-time delivery of products, right? But we've seen the problems with that. We've seen the risks from that. Today and now, we ask the question, there are some, let's say, important, or should we say critical medical medicine, really, that are provided largely or produced largely in Southeast Asia. And if you do not have the transportation links with them, then you would be in trouble. So I'm just making the point that maybe what we need to do is to think of those extreme scenarios that we heard or that we thought about are not that extreme. There are things that can happen. So I think the issue here is how should we strengthen or buttress the existing supply chains, particularly for critical facilities. And I think one of the things that we know, I'm now talking of the banking sector, is those sort of crisis response. One of the things we, in our business you have a list of your critical suppliers, whatever they are. It could be even IT suppliers and things like that. So maybe that is something we need to come up with, a sense of what are critical needs in a case of an extreme scenario such as this. But I think those are things that we can think a little more, let's say, calmly when the crisis has passed and we have maybe put together our thoughts about the lessons.
There's a series of questions which largely revolve around the same matter. And these questions are by Kefa Morero from Citizen, Paul Wafula from the Daily Nation, and I believe David from Bloomberg News. That could be David Habling or David, the other David from Bloomberg News. And the questions are around the facilities from the World Bank and the IMF, primarily to do with what are the amounts and when can we expect these to be coming in? from
Okay.
Kefa, from Paul, and from David.
Okay, so what I was doing here is signaling that those facilities are coming. I think we'll be having, in the context of the announcements of the fiscal measures, which will happen very shortly, in a matter of days. I think your questions will be answered in the press briefing that will be announcing that. So the details in terms of the amounts and things, I think those will be confirmed in that context. But I have already given you the general numbers. I've also given you the general sense of how quickly this will be coming. We are thinking in a matter of, by end April. So end April, early May is when all this, at different times, of course, will be coming in.
All right, another combined set of questions from Alushula of the Business Daily, again Paul Wafula from the Daily Nation, and a few others who have, in a sense, asked questions about the transmission of these lower rates to customers. What guarantee do customers have that these lower rates will be transmitted to them, and what happens if banks do not transmit these lower rates to their customers?
I think the point here is you should begin to understand how the financial sector operates, and it takes time to have the transmission from the announcement to the end. But I think the point here is, so to expect it to happen the next day is to misunderstand how businesses work and to misunderstand how the financial sector operates. So this will be gradual. This will be a gradual process. Actually, our estimate is that it takes about 2 months before things begin to be, for us to begin to see that the changes are taking place in the borrowing rates, right? But as I said, this change is also is really targeted on the deposit rates, because in a sense that sets a floor on the lending rates, and you could say that that is the cost of funding or the cost of funds. So we need to create more room and also have the depositors take a bit of the cost of the crisis. So that is really how we expect that to unfold going forward.
All right, and that question that the governor has just answered was similar to what was asked by Julian Zamboko of NTV and Dominic Omondi of The Standard, all that to do with the transmission speed and effectiveness of transmission of these lower rates. We have a question including by Victoria Munga, but it's been asked by several other people, which is to do with whether the central bank recommends a total shutdown or a total lockdown, and if the pandemic persists and becomes worse, what then are the options for the central bank?
I think there are two things I've mentioned. First, like we said at the beginning, follow the instructions as provided to us. Follow the instructions as good citizens. It is our civic duty to make sure that we stop this pandemic before it consumes us in the economy and indeed ourselves as a people. So